Welcome to Real World Real Estate, where we will explore, examine, and explain the real process of buying or selling real estate. Here is your host, Stephen Clyde.
Hi, everybody. Welcome to Real World Real Estate. This is Stephen Clyde, your host with RE/MAX Preferred and RE/MAX at Cherry Hill. Today, we're going to be talking about the mortgage pre-qualification and pre-approval process, what you should expect, what you're going to need, and how this relates to you putting in an offer and qualifying for a home and moving forward with your home purchase. Some of these things will also apply to a refi, but mostly we're going to be talking on the purchase side. So we're going to be speaking with Jim Reed, who's with GreenTree Mortgage. I've known Jim for over 17 years. He's done a vast majority of our clients' mortgages, my own personal mortgage, my niece, my goddaughter, my daughter, my sisters, family members, vast majority of our clients. He's very detail-oriented and a little OCD'd. We tease him about that a bit. But those are really good traits when it comes to being a mortgage loan officer. So, Jim, thanks for joining us today. It's a pleasure to have you here.
Thank you.
So let's dive in quick and let's talk about the pre-qualification process, because most new first-time home buyers aren't going to understand what's going on, or they think they have to dedicate hours of their time to get this process going. So if I'm a first-time home buyer and my real estate agent just told me to call you to get mortgage pre-qual so I can put an offer in, what should I expect when I make that phone call?
That we're going to take some personal information, like your name, your social, your address, your job history, and depending on what you do for a living and how you get paid, it's going to determine how complex it's going to be. So, for instance, you're an IT professional, salary, it's pretty simple. If you're a bartender or you're self-employed or you're getting 100% commission, then it gets a little bit more complicated because we need a 2-year history of your income to average it. If you're just a base income, like a teacher or IT professional making 60 grand or 80 grand, it gets a lot easier for your income portion. Then there's the credit portion too. So we get all your information, takes approximately 5 to 10 minutes, depending on, especially if you're a first-time home buyer. If you own a bunch of properties, it does get a little bit more complicated. But if you're a first-time home buyer, it's usually pretty simple. It takes 10 minutes tops. We put everything in through our system. We run your credit. Then we run you through an automated system that pretty much every company uses. And then it lets us know if how much you're approved up to. That's pretty much the basics.
All right, so that's the basics. So let's say I'm calling you. I'm a union plumber. I'm an hourly rate, but I also get overtime, or I'm a nurse that gets overtime. How does it apply to someone that, their pay, they're not self-employed, they're not in sales, they're not in commission, but their pay varies from week to week based off of their overtime? How do we calculate that in? How do we look at that? Do we look at it at all?
So if you have fluctuating income, and if you have a base income, let's just say, like, for instance, your base is 50 grand a year, and then you have overtime on top of that. And 2018, you made 20,000 in overtime. 2019, you made 15,000 in overtime. And 2020, you're on target to make $10,000 in overtime. Well, we're just going to use the best case scenario. We're going to use the 10,000 for the overtime. We're not going to use your 18, 19 because your overtime, your fluctuating income is declining. If it was the opposite and you made 15,000 in 18 and 20,000 in 19, and you're on target to make more than that this year, then we average it over a 2-year period. Plus, we use your base. So when you have extra income, bonus, commission, tips, it's averaged over 2 years. And then you take the most conservative approach. So if your 2020 is the most conservative approach because of this pandemic, then that's all we can give you. If 2020 you're on target to make the same or higher, then we average it over 18 months or 2 years or 3 years, depending on what month it is.
All right.
If you're in the local.
Yeah, and you're taking this all verbal from me at this point, right? You're not We're not at verification mode or anything right now. You're taking my verbals at this point.
I take your verbals. So basically, if your base is enough to qualify you and your ratios are still, you have plenty of room for tolerance in case the taxes are higher or insurance are higher, then it's, we pretty much, are good from there. But if your ratios are extremely high on your base only, your base salary, which is not fluctuating, it's the same every week or every 2 weeks, or we need to use your overtime, bonuses, commission, then we definitely, get your W-2s and pay stubs, and we order a verification of employment from your employer to break down and average your fluctuating income.
Okay. So let's stay on income, and then we're jump into the ratios a little bit so everybody understands what we're talking about. So that was an hourly rate with an overtime, but let's say someone that's bonused or commissioned, but they're W-2, they're not self-employed or 1099. You're doing a 2-year average on that as well. So a 2-year average, if I'm a pharmaceutical sales rep and I've got a $50,000 base, but I average another $25,000 a year in commissions, you're doing that same, the most conservative approach, right? Either the 2-year averaging or the lower of the years, right?
The only thing that we don't average is your base guaranteed salary. So if if your salary last year was $35,000 and now it's $45,000 because you had a promotion or raise, we're not going to average your last year's base with this year. We're going to take your new base. But anytime income is fluctuating, different from week to week or month to month, then we average it over. They want to average it over a 2-year period to see the historic, the historic amount that you're making each year. And if it's declining, that could be a problem. They want it to be stabilized or increasing, and then we average it over 2 or 3 years. We average it over 1 to 2 years, depending on what type of income it is and how long we've been getting it for. But if it's declining, then the best case, we use the most conservative approach. If it's declining and we can't determine it's going to keep continuing, like for instance, you're in the hospitality field and you're working 20 hours a week of overtime, then you get this pandemic coming along, and now you're just doing your 40 hours a week and your overtime has stopped because of, there's no extra work. We're not going to give you any credit for your overtime. So it's a case by case basis, but basically for the most part, if it's your base income, we use that income as long as it's the same every week or every month. If it's fluctuating, we take the average.
Okay. All right. And then if it's somebody who's self-employed, so I'm a plumber and I own my own business, or let's use me, I'm a real estate agent, right? So I get a 1099 every year. Someone that gets 1099 versus W-2 is a little bit more complicated, right?
I mean, it's actually easier to figure out their income, but because you're just going by what's on the tax returns. I mean, basically, we're going to do the same thing. We're going to get your 2018 tax returns and your 2019 tax returns. And assuming you made 50 grand in 18 and 80 grand in 19, we're going to take the 50 plus the 80 and divide it by 24 months. And then you got to write down the profit and loss of what you made so far in 2020 to make sure your income is not declining. But if self-employed is actually, it's more of it's actually easier to figure out than when somebody's working, 20 hours this week and 30 hours this week and 15 hours this week. It's kind of harder to figure out. But when you're self-employed, you're just going by what's on your tax returns. It's pretty cut and dry. Like if you had 5 different people coming up with your income on self-employed, we should all get exactly the same thing. If your income is fluctuating, it could be a call. Do I use 1 year? Do I use 2 years? Am I just using year to date? I mean, we should all approximately do the same thing, but it's a little bit more of a gray area.
Okay, but on that self-employed person, so let's just say my, self-employed person, their 1099 says $100,000 for each of the last 3 years, but you're not using that $100,000. You're using the $100,000 minus the Schedule C and whatever adjustments.
we're basically using whatever you pay taxes on. So if you make $100,000 on your 2019 tax returns as gross, that's how much you made all year, but it cost you 60 grand between expenses, food, advertising, whatever you have for expenses, and your net income is 40,000. Well, then we look at it, it cost you 60 grand to make 100 grand. So really you only made 40,000. That's what you pay taxes to the government. There's a couple more things you could do to add more income to that, but for the most part, that's what we look at. We look at for self-employed only, we look at the 40 grand versus the 100 grand. If you're W-2, we go by the opposite. We go by gross. So if you're making $5,000 a month gross and you get $1,200 a month between your 401k, your federal taxes, your Social Security, and you're bringing home $3,800, we're going to use the $5,000 a month for gross. So it's kind of like the opposite.
Okay, so self-employed, you're going to use my net basically, but
Yep.
W-2 standard employment, you're going to use my gross.
Correct.
Okay. Now, a little bit ago, you mentioned ratios, and we all talk what I call inside baseball, right? We use all of our different terms, DTI ratios, front and back ratios, but from a layperson that doesn't speak our real estate lingo, when you're saying ratio, you're talking about the debt to income ratio, right?
Correct.
And we're talking the front ratio, or all right, let's back up there. I know there's two ratios that mortgage company uses, front and back. What's the difference there?
Front is so basically the qualified income. And the qualified income is going to be either the gross income if you're a W-2 or the net income if you're self-employed. So, but we're going to use the qualified income. So I'm only going to say 10 grand a month only because it's easy for math. I know 10 grand a month is a lot. I'm going to use that for just easy calculation. So if you're making $10,000 a month of qualified income, then your front ratio, depending on what program it is, has to be a certain amount. And that's with the mortgage payment, the real estate taxes, the homeowner's insurance. If you're getting flood insurance or HOA fees, all that is included in, it's called a PITI, the principal, interest, taxes, and insurance. That's your front ratio. So if your mortgage payment is $2,000 a month between your taxes, insurance, your PMI insurance, and you're making 10 grand qualified income, then your front ratio is a 20%, which is pretty low.
Okay.
And it depends on what program you do. I mean, they want you to be like, if you weren't relying on an automated system, they want your front ratio to be somewhere around 30%. So if you're making 10 grand, they want your front ratio to be, they want your housing payment to be under 3,000. That's like being very conservative, but with these automated systems, depending on your compensating factors, like, if your credit scores are excellent, if you have extra money in the bank, then you could go higher than the 30%. And some programs will let you go up to 46%. So again, if your mortgage payment is $4,600 and your income is $10,000, that's 46%, and that could be provable depending on, the compensating factor. So there's a range, but, if you had to say, where should I be at, it would be like around 30% for your front ratio, which is your housing payment only, including taxes and insurance.
Okay. Then the back ratio is when we're adding all the other debt into it, but we're only adding debt in, we're not adding expenses. So we're not counting food, utilities, gas, or any of that. We're just counting what is paid as required debt, right?
Correct. You're only adding in what's reported to the credit bureaus and any kind of alimony or child support or separate maintenance. But basically what's reported to the credit bureaus are credit cards, and we always use the minimum payment. So if you have doesn't matter if you have a $2,000 credit card balance or a $5,000 credit card balance, we use what the minimum payment is. So if you have a $2,000 credit card balance and your payment's $50, the minimum payment, and you have a $5,000 credit card balance and your payment's still $50, we're just going to use the $50. So it doesn't make a difference if your balance is higher. It goes by the monthly payment. So basically, it's a credit card debts, your minimum payment, student loan debts. Student loans are a little bit, I guess, more complex depending on what program you do.
Yeah,
Like,
why don't
for
we
instance,
come back to those because they get a little bit more. Let's stay on
student loans, car payments, personal loans. So all this stuff is reported to the credit bureaus. That's what we use to calculate your total debt to income ratio or your back ratio. We don't count utility bills. We don't count car insurance or cell phones. We don't count that stuff. It's just whatever is reported to the credit bureaus. And that's basically, so you're going to add up. So if your mortgage payment, including taxes and insurance, is $2,000, and you have $1,000 worth of car payments and credit cards, then your total debts are $3,000. You're dividing it by that $10,000 qualified income, and your back end ratio is 30%. So your front ratio is 20% because your mortgage payment is $2,000, and your back end ratio, because you have $1,000 extra monthly debt, then you have a 30% debt to income ratio.
Okay.
30% on today's market is pretty low. Some programs let you go up to a 45%, some let you go to 50, and some go to 57. And believe it or not, some even go higher than that, depending on the whole situation. But that's the ratios. And it's just a simple mathematical equations. You got to find out how much debt you have that gets reported to the credit bureaus, plus alimony, child support, your new housing payment divided by your total qualified income.
So if I wasn't a first-time home buyer and I was buying, I don't know, a vacation home or an investment home, you're going to take my current mortgage payment, all those other debts, add those up, and then add on whatever I'm buying next, and then that still has to stay inside that back end ratio that we're looking for, that percentage point, right?
Correct. Yep.
Okay.
Exactly.
So, as the mortgage company, you guys will say 45% is acceptable. I know it can go higher, right? I mean, some of them go 50, and as you said, even closer to 60%. But in realistic terms, that's not necessarily what I should be spending, right? Because if I'm at 50% on that back ratio, and we use the 10,000 that we've been using, so that means my total monthly debt is $5,000, but I still have to buy food, utilities, gas, my car insurance, turn my light.
Because you're only bringing home $7,000, because you got $3,000 of taxes and 401ks and pensions or whatever. So you only got $2,000 a month to live and to save. So it's not optimal to go up to 50%.
Right, that's a little dangerous, and that's when you put yourself in a position to probably become a statistic with us. So just because you run my pre-qualification and say I can afford X per month, let's say $3,000 per month, from an underwriting standpoint, that's what I'm qualified for, but that may not be the prudent amount that I should spend every month, right?
Correct. And that's one of the, the responsibilities of the borrower to figure out where they feel comfortable. That's basically because, you get somebody who doesn't go out to eat, doesn't, have a lot of spending habits. They might be able to stretch their income to 40, 45, 50% of their total qualified income. But you have somebody who has, a few car payments, a few cars, and they have a bunch of, high insurance, or you go out a lot, or you eat out a lot, or you have a couple kids that you're, putting money to daycare or whatever the case is, then, you shouldn't go to 50% because you're not going to really have any money left over.
Right.
And, you have other significant other, boyfriend, girlfriend going to be living there, and they're going to help you make that payment. I mean, that's today, but 3 years from now, who knows if they're going to be there, and they could just walk away with no liability. So you're stuck there. So, my advice would be, don't go to the max. Even though you have somebody, a friend, roommate, boyfriend, girlfriend going to be living there, it's never smart going to the max. Now, if you're just getting out of residency for a doctor and you're making $60,000 a year, and in 2 or 3 years you're going to be making $150,000, then it's a different story. So there's always exceptions, but for the most part, if you don't have, there's not a lot of promotions in your job. You're going from $50,000 to $55,000. Then you should be a little bit more conservative on how much you get approved for. And just the mortgage company, I could tell you that, you should stay around 30% of your gross monthly income. but I don't really know you per se, so I could get you approved for a lot higher. But I think it's the responsibility of the borrower to determine, I can't afford a $4,000 a month housing payment, even though I could qualify for $4,000, making $10,000 a month. I shouldn't get one because I really can't afford it if I want to have the same living habits and spending habits I did previously.
So if I want to eat something other than ramen noodles every night, I should probably pull back on that a little bit.
Exactly. So it's between both of us. It's between the mortgage loan officer and the person trying to get the mortgage. It's both, collaborating, determining what's the best. I could just tell you, a lot of people come to me and say, what is the most they qualify for? That's all they want to know. They want to know what the most they qualify for. So, well, you're making $10,000. You don't have much debt. Well, do you qualify for maybe $4,500 a month? But is that where you're supposed to be at? Reality, is that where you want to be in 4 years from now? Still making that same $10,000? Do you really want a $4,600 monthly payment? You're not going to really have much money to do anything else with because that $10,000 is your gross. Your net is probably $6,500 to $7,000. So you don't have a lot of other money. So you have a kid, and your the other $1,500 to $2,000 is taken away per month. So it's so I can tell you what your max is, but it doesn't mean that's where you should be at.
And you guys aren't looking at family situations, right? So you're looking at, let's say, me with no children and no credit card debt, and I'm getting the exact same ratios as someone that's in my exact same income and debt situation, but they have 4 kids. You guys do not take into account the expense of those 4 children. You're just looking at debt to income, and that's it.
For the most part, you're correct, but the lowest default ratios, especially in this credit financial from the last 10 years ago, the lowest default of all these entities like conventional, FHA, VA, USDA, was VA. So if you're a veteran, because when you're a veteran, we go by if you have 2 kids, if you have 3 kids, or if your house is 1,000 square feet or 3,000 square feet, if you have childcare expenses, VA calculates all that stuff in there, and they make sure you have enough net income, like cash income after all your expenses, after you pay your credit card, your childcare expenses. If you have a 4-person household or a 2-person household, they care about how much money is left over. Other programs, USDA does a tiny bit, but for the most part, conventional FHA, it doesn't make a difference if you have 20 kids or no kids. We still qualify the same way, as long as you're not paying support, like child support or out. And we're qualifying. So you have 10 kids, I have 0 kids. We make the exact same amount of money. We have the exact same debts. We're going to improve the same amount. And that's why it doesn't look at the whole picture. And VA looks at the whole entire picture, and that's why their default ratios are less. But also VA, I've seen VA, this is a little bit not off topic, but a little bit out of the scope. I've seen VA go over 65 debt to income ratio. So if you make $10,000 a month, I've seen you get approved for up to $6,500, including your debts. So, VA could be the most lenient, but it's also taking the fact how many people you have living there, how big the house is, child care expenses. So, for the most part, you are correct. We don't look at that stuff, but VA we do.
Okay. All right. That makes sense. So let's talk about a couple of the other things that we brought up that didn't broach on. So we'll start with child support alimony. All right. So if I'm paying either one of those two, if I have to write a monthly check for child support or for alimony or for both in most cases, right, that's getting added into that debt to income ratio. You're counting that as one of my monthly debts. That's even though it may not be reporting on the credit bureaus, you're calculating that in. You're asking me that question if I pay those or not, right?
Correct. So if you have $1,000 a month in child support, it's like you having a $1,000 car payment. It's the exact same thing. Okay.
But you're basically taking my word on it, or are you asking for the court documents on that? Or that's coming down the line when on the writing?
Well, unless you're really maxed out and you're trying to qualify for your highest, we do go by your word for the most part. But obviously, once you find a house, and then then it goes through underwriting, we get the title report and all that stuff, and then we ask you to log into your child support and then verify that you're paying $600 a month on your garnishment. then we verify all that stuff. So to leave that out of the equation when you're doing the pre-qual does nothing but waste a lot of time and money.
Right.
So what people do all the time, they're thinking, well, they're not going to know I pay child support, just start it, whatever. Well, we have all these different reports to find out, that the underwriter runs, and then we're going to find out last minute, and you just paid for inspections and termite and appraisal, and got all your hopes up, and the last minute you don't qualify anymore because we just found out about child support or alimony. So it's never good to leave anything out. But yes, we take your word for it up front for the most part.
Okay. So let's flip that. Let's go the other way. My ex-wife is buying the house and calling you for the pre-qual, and I'm paying her $500 a month in child support and $500 a month in alimony. So if you were pre-qualing me, that's going against me, but are you giving that to her as a credit against that debt to income?
Correct. As long as she could prove that she's been getting it for 3 to 12 months. And I say 3 to 12 months, it depends on what program you're doing and how the child support, if it's court order or if it's voluntary, then, but we need to see the divorce decree or a separation agreement or the child support case number showing how much you're getting, and we need to prove that you've been getting it consistently on time for somewhere between 3 to 6 months, depending on what program you do, in order for us to use it. So if you haven't got it last 2 months, we're not using that income. We're only going to use the income if we could verify it, that you're getting a certain amount and it's consistent and you've been getting it on time for the last so many months. So yes, we do that.
When you're saying getting it on time, if I'm a deadbeat and I'm not paying my child support or alimony, and that ex is taking me to court to force me to pay it, if I'm a bad pay to my ex, then you're not giving her the ex credit for that money, right, because I'm a bad pay in getting it to her. She has to show consistent on-time payments.
Yes, she can't rely on it, right? She's not getting it on a consistent basis, and so we can't rely on her to qualify with that income. Because if you continue not to pay her, she doesn't have that tangible cash to pay the mortgage or her bills.
So then what about some of the, some people, when they get divorced, the alimony is only for a specific time frame, right? So maybe we finalized the divorce last month, sold all the houses. The ex is going now to buy a house now, but she's only going to get alimony for the next 5 years or 7 years or 10 years. It's not permanent. Do you guys still calculate that, or do you make an adjustment to it because it's a limited time frame?
So mortgage companies go by, just a general rule of thumb, if it's going to continue for 3 years or more, then we use it. If it's going to continue for 3 years or less, we're not going to use it. So any job that you have, we're going to make the assumption that it's going to last forever, or you can get a new job right away. So we're going to use that income. If alimony, child support, your child's 16 years old. We're not going to use child support because they're 16 years old. Even though it's possible for them to go to college and you to pay, you still get child support, but it's really hard to prove that when you're 16 years old, a child. And how do you know that 16-year-old is going to college? So if your child's 14, that child support should last to at least 18. So we're going to give you, we could use that child support. But if your child is 16 years old, most likely we're not going to use that child support unless there's something you could prove that's going to show that it's going to continue for 3 years or more. And same thing with alimony. If your alimony, there's a lot of times alimony is to the spouse dies or you get remarried, then basically we're going to use that. But if it says your alimony is going to stop 2 years from now, then we're not going to use it. Doesn't matter. We're not going to tier it. We're not going to give you anything. So if you get $3,000 a month in alimony and it's going to stop in 28 months, we're not going to use it because it's not going to last for 36 months or more.
Okay. Now, on the other side of that coin, so I'm the one paying the alimony or the child support, and there's only, let's say, 18 months left on that time frame for me to pay that. Are you still counting that against me in my debt to income ratio, or because it's a shorter time frame, am I getting some relief on that for my debt to income ratio as the pay?
If it's 18 months left, you're not getting any relief at all. If it's less than 10 months, and we can prove it's less than 10 months, then there's a possibility we don't have to count that. And there's other factors that go into it, but if it's more than 10 months, we definitely have to count it. If it's less than 10 months, there's a possibility we can exclude it from your debt to income ratio.
Okay. And then probably the biggest, I mean, that's one of the biggest ones we always come across. But the other one that I see all the time that usually messes us up is student loan debt. So let's use that. I'm that first-time home buyer. I've got a great job. I'm making $100,000 a year. 4 years out of college, but I'm carrying $100,000 in student loan debt. So if I'm in deferral, how does that affect me? And if I'm out of deferral, how does that affect me?
I mean, this is like kind of a complex question because every program is going to have a different outlook on it. Right. So the most common program for FHA, which is, for the first-time home buyer, it's not, FHA doesn't mean you're a first-time home buyer, but a lot of people associate that because it has a low down payment. The seller could pay all your closing costs, and the credit's more liberal. So, but it's definitely going to have FHA loans 15 times in your life if you want to.
Right.
So, but for FHA, if you have $100,000 in student loans, for the most part, we're going to use $1,000 a month. We're going to use 1% of your balance. So even though your credit report says $200 or $100 because you're paying it based on how much you're making per year, which is income-based driven, we're not going to go by that. We're going to use 1% of the balance unless the credit report says something higher, we're going to use higher. So for instance, $100,000 student loan, you have a $200 monthly payment on your credit report because that's what you're really paying, or it's deferred, or whatever the case is, we're going to use $1,000 a month. The only time we're not going to use $1,000 a month if it says $1,200 a month on your credit report, then we're going to use $1,200. There's other factors that we could get from the creditor saying that we could use $800 a month if we could verify it's fully amortizing. But I mean, there's everything I'm saying is black and white, but for the most part, that's the way the guidelines are.
Right. There's always exceptions or compensating circumstances in all these programs, but we're going to talk in general terms and not dig down. All right. So that's an FHA. You're going to hit me for 1% of my balance. You're going to hit me for the higher of 1% of my balance or whatever my true payment is. And then if I'm going conventional or USDA or VA or any of the other programs, how's that play out?
Conventional, it's going to go by whatever's in your credit report. So if you have $500,000 in student loans and you're making $50,000 a year, and your student loans monthly payments based on your income. So it doesn't matter if you have $200,000 in student loans or $1 million in student loans. It's going to be based on your income. So your income is $50,000. It's going to say, all right, and I'm making numbers up here. Your monthly income payment is going to be $400 a month because it's based on $50,000. It doesn't matter how much your balance is or your student loans. It's going to be based on your income only. We're going to use that monthly payment. So if you're making $50,000 a year and your monthly payment's $400 on your credit report, we're going to hit you with $400. We're not going to hit you with 1%, which is a huge factor. And this is a newer thing because that wasn't the case before, but that's a huge help. So if somebody's like coming out of medical school and they have hundreds of thousands of loans and they're just starting and they're only making $60,000 a year, well, it's based on their income, which is going to be a low amount. That's what we're going to use because it makes more sense. Because why use, using a $300,000 balance of student loan? Why use $3,000 a month when you're only paying $500 a month because of your income? Well, if you're making next year, if it goes higher, it's because your income's higher. So you're making more money. So it makes more sense. FHA just makes it like really 1%. So for conventional, it's whatever shows on the credit report. If it's based on income, if there's no payment, we use 1%. If there is a payment, we use that payment. So it's a lot easier and a lot more flexible. VA, if it's deferred for 12 months or more, we don't count that against you at all. If it's not deferred for 12 months or a year or more, then we use 0.5% divided by 12. So each one's going to get a little bit more complex, but it's basically, every entity, VA, conventional, FHA, has their own way of coming up with a formula to come up with your monthly payment we need to hit you with for your debt to income ratio. But conventional is the most lenient because it's whatever is on your credit report, that's what we use.
Okay. So, this is all the stuff that we meant to make sure that a buyer, has prepared for them. So if they have other sources of income, right? So if I have passive income from rental properties or I'm trying to think an annuity, anything else, like all of my total income and all of my debts, you need to know that all up front when we're talking, right? And then you're going to verify it through the credit report or down the line through tax returns or talking to my employer or looking at my W-2s, right?
Yeah, we're going to do all that regardless, but, a lot of times we do it up front to make sure, you're not wasting the realtor's time and your time by showing houses that, basically a common problem usually comes into like you're factory workers, let's say, and you're making $20 an hour. And we ask you how many hours you work a week. Oh, I work 40 hours a week. And then when we get your pay stubs and your W-2s, it doesn't show 40 hours. It shows like last week you worked 39 hours, and the week before you worked 36 hours. And because you took off, or you're not guaranteed 40 hours. You're just basically you're scheduled to work 40 hours, but life happens, and sometimes you don't work 40 hours. Well, we can't use 40 hours. So we take your word for it that you make $20 an hour and you're working 40 hours. When we actually get your income verified, it shows your average hours per week is 35 hours. Well, we can't use 40, so we're using 35, and that might put you over the edge of qualifying for that specific house. So right. Even though somebody's not like trying to give us any wrong information, it's just they're saying, yeah, I work 40 hours a week, but they're not really thinking like, well, it took off. I don't get paid for 40 if I'm not working. So Labor Day has happened. I didn't get paid for it because I didn't work because I couldn't work. If it snows or I'm sick, I don't get paid for these days. Then we're averaged, then you're fluctuating income, and we're averaging your hours. If you're salary and you're making $40,000 a year, regardless if you work today or not, you're still getting paid for today. And that's a guaranteed income. That's when your income is not fluctuating. But if you're getting paid per hour and you don't get PTO, which is paid time off or personal days or sick days, then your income is considered fluctuating unless you are one in a 1% chance that you work 40 hours every week for the last couple of years, then it's not considered fluctuating. But for the most part, things happen, sick or whatever cases you don't work the full 40 hours. And that's a lot of times where people screw up with the pre-quals. They take your word for it that you're working 40 hours and you're getting approved for, a high amount for your debt to income ratios. And then once you go under contract and you're all excited and you're spending all this money for termites and radon and home inspections and appraisals, once the mortgage company gets your income and the underwriter looks at it, well, you don't really work 40 hours, you're working 35. You don't qualify for this house unless you pay off this car or you get a cosigner. So these are the things is why, for the most time, it's better to verify this stuff up front, because even though, like I said, you're not lying to us, we're just thinking two different things. You're thinking that you are scheduled for 40 hours. We care about how many hours have you been working for the last 2 years. So that's a big problem where a lot of pre-quals fail, where they just base it on when your ratios are high, they're basing it on everything verbally without actually documenting it.
Right, and we just went through this with the one client I'm working with now, who's the nurse, where she was pre-qualified for a specific amount. Then she spoke to you guys, and her income was she stated her income was higher, but before you guys issued the new pre-qual, you did a full verification on that with the employer. You confirmed those numbers, right? So we didn't run into that. She finds her dream house for $360,000. We send everything in the underwriting, and then we find out she was only approved for $340 because she was off on how she gave you her hours.
Maybe it's pandemic, or she just had a newborn and she's only working 24 hours, even though she's able to work 36 hours. So, like I said, it's just the way they convey the message to you. That's why, now if you're a teacher or like an IT professional, you're making the same amount. Doesn't matter if you're working or not. But right. If you're an hourly employee and you don't have paid time off, then we definitely want to verify your income up front before you start getting too attached to a specific house.
Right.
So even though it might be more work up front, and it seems like, well, this other mortgage company didn't verify my income. Why are you verifying my income? It's because we're just making sure that we don't tell you 2 weeks before closing that you can't buy your dream house.
Right. And then everybody gets pissed off and there's a huge problem. Exactly. Right. That makes sense. So, all right. So we've covered a large part of it, and we touched on credit score a little bit. And we're going to touch on credit score now. If anybody wants to dig in deeper to it, we have a previous episode where I spent an hour on the credit score. But I wanted to talk about how it applies to a mortgage. One, credit score is going to affect rate. It's going to affect where I fall on those front and back ratios we discussed. But I think the biggest one is when people call into a loan officer, and we come across this a lot, and you tell them, well, look, let's just recheck that with another company, or let's shop that around to a couple companies to make sure you're getting the right closing costs and the right interest rate. But I hear clients all the time that say, well, a mortgage company told me not to call anyone else because they don't, if I get my credit run again, it's going to lower my credit score. Now, I know I covered in a previous episode that if I go for car loans or if I go for credit cards, that will be the case. But, and correct me if I'm wrong, that's not the case when I'm applying for a mortgage, right? They expect me to shop around and check on mortgages. And
they want you to shop, and nobody's really thinking you're getting more than one mortgage at a time. So it's not you're talking to 3 different mortgage companies and getting 3 different mortgages. So that's not the case. Like credit cards, you could get 3 different credit cards, no problem. And that draws a red flag to the credit bureaus. All right, this person is opening all this new debt. And a lot of times, like the backstory to that is a lot of times when somebody's about to claim bankruptcy or go into a dramatic situation, they might open all this new debt. So, the credit bureaus have no idea. So they flag your credit scores, and, your scores drop temporarily until it gets, all comes down. But for mortgage companies, if you run your credit 15 times in a 2 or 3 week period, it's probably 45 days. I don't know the exact amount, but it's definitely out there on the internet. If you went to the CFPB website, it definitely tells you. But my guess, it's probably within 45 days. If you get your credit ran 5 times, 10 times with different mortgage companies, it's not going to hurt your scores at all. It's going to be one, even though it might show up as different inquiries, it won't bring your scores down at all.
Okay.
And basically, they want you to shop around. The mortgage company doesn't want you to shop around. So, like, for instance, you come to me for a pre-qual, it's very, the reason that I would say, not me per se, but the reason why somebody would say, if you go to another mortgage company to run your credit and your scores will drop and you're right on the borderline, they're trying to scare you from shopping around. So, but it will not hurt your score, but they're telling you this so you don't go to another mortgage company. You're scared that thinking, well, this other mortgage company, even though they might give me a better deal, if I run it, it might drop my scores 5, 10, 15 points, and I'm not going to get approved anymore. That's not the case.
Right, but if they do run out so you do the pre-qual for them and they shop for the mortgages, but at the same time, maybe my lease is coming due on my car and I go look at a couple different cars and each car dealer runs me, that could have a negative effect and affect me getting the mortgage, right?
Correct.
Okay. Or the same thing, I get the email from Experian or whoever, and there's a great transfer balance rate with the Discover card, or American Express is offering so many bonus miles if you sign. If I start signing up for all those cards, those inquiries will lower my score as well.
Correct.
So inquiries can lower your score, but not if they're coming from a mortgage company. That's the myth. That's the falsehood. And that's really like a used car salesman approach to, I'm locking you into me so you don't go shop, and I'm using fear to do it.
Correct. It's right on the CFPB, like C is in Charles, F is in Frank, P is in Paul, B is in boy website. It tells you, if you went there, it'll tell you what happens if I get multiple mortgage companies running my credit. And it tells you, I think it says 45 days, I'm pretty sure, but it tells you that you want to shop around. You don't want to just take the first person you talk to. So that's the reason, that's the reason why it doesn't affect your score, but that's the reason why a mortgage person might tell you it does, so you don't go to other places.
Right.
So it makes sense, it makes sense on both sides, but this is why you hear conflicting stories all the time.
Right, exactly. Now, when you run my credit, and again, I covered this a little bit in the previous episode, but we're touching on it here so it's clearer. If, I get my Credit Karma or my Experian and I get my free report, and I think normally when they post it, it's FICO score 8. So let's say I have an 800 FICO score on Credit Karma or Experian. That doesn't mean I have an 800 score when you run my credit, right?
No, each entity, like a mortgage company or a car company or consumer report, like Credit Karma, they're each going to have all the same information. So if there's a late on their collection, or it'll show you the car payments you have and the credit cards you have, all that stuff's going to be exactly the same. What's going to be different is the way they score to get your credit scores. So for instance, like a car company, they don't care if you're maxed out on your credit cards. So you might you might be maxed out on your credit cards, and to a mortgage company or a credit card company, we care about that and they care about that. So it's going to bring your scores down, but a car company doesn't care because they're giving you an installment loan. So you might go to the car company, have a 750 credit score. You might go to the credit card company or a mortgage company, you might have a 650 credit score, because each things are different, has different relevance for each entity. So that's why, you can't, it's good to have Credit Karma or, run it through Experian just to know what's going on with your credit report, but you can never rely on them scores when you're getting a mortgage. So that's like probably the biggest thing we hear is like, yeah, I have a 670 credit score, and we run it, we get a 620, and we got to be very explanatory and let the buyers know it, because you ran your credit with us didn't bring your scores down. Well, part your scores are different because it's a different scoring system. But if you have 5 different mortgage companies run your credit all on the same day or the same time period, and nothing's changed with your credit card balances, the reporting dates, everything was exactly the same, you're going to get the exact same score with each mortgage company.
Okay, that makes sense. And then I'm going to get, so we have 3 different credit bureaus: TransUnion, Experian, and Equifax. So, I may only be seeing one of those when I get my Credit Karma. I don't know which one they pull from. So I think they pull from Experian, but I'm not 100% sure. You're pulling what I always refer to as a tri-merge. So you're pulling all 3 bureaus simultaneously. And then how are you looking at all 3? Because those 3 could be, not every creditor reports to all 3. So that all 3 of those scores there could be a variation in those 3. So how do you guys look at those 3?
Well, so for the actual score part,
yeah,
we do away with the highest and we do away the lowest and take the middle score. We don't average the 3, it's just the middle score. So you have a 520, a 540, and a 750. We're going to take the 540 credit score. And the reason why you have a 750 and the other ones are 500, 520 and 540 is because you might have a collection or something reporting to the 2 credit bureaus is not reporting to the 3rd credit bureau that's giving you a higher score, which is very common. So that's why they fluctuate. So but we look at the whole credit history. So regardless, we look at if one trade line, like a collection, only reports to TransUnion for some reason, we're still going to take that in our assessment when we underwrite your loan. But for the actual credit score, which determines your interest rate, how much you put down, we're going to go by the middle score only. So like I said, we're going to take the first score and the highest score and the lowest score, and we're just going to use that middle score.
Okay. So, I don't need an 800 or a perfect 850 score. Not that I've ever even seen a perfect 850, but I don't need that extremely high credit score to qualify for a mortgage, right? Where you hear on the news all the time, it's a credit crunch, it's hard to get a mortgage, you need, this really, really high credit score to get it. You guys are relatively lenient on credit scores as far as approving people depending on the program, right?
Yeah, the credit score, if it's a 740 or a 780 or 800, it's pretty much the same. You're going to get the same interest rates. The PMI insurance on a conventional loan could be a little bit different. The higher scores, the better. But if you get approved with a 660 credit score, then that's high enough to get approved. You might get a little bit higher rate than you would if you had a 680 or 700 credit score, but so the credit score, the higher score, the better, the obvious, but it doesn't mean like if you have a 750 or 820, it's going to make any difference at all. Because once you're really above a 740 credit score, you're getting the best interest rate. But you can have a 660 or 680 and still get approved for the exact same program, but your rate and your PMI could be affected a little bit higher.
So your payment could be those two customers, the 700 and the 680. They can get the exact same program. They can meet all the same criteria, but one might get slightly lower mortgage insurance rate or an interest rate than the other one due to that difference in score.
Correct.
Okay.
Correct.
But the baseline is relatively low, isn't it? Like, are we at a 600 now or 640, or where's our baseline now?
For the most part, it's a 640 because of this pandemic. Before the pandemic, most mortgage companies were at 580. And there still could be some companies still doing 580 credit scores. But, once April came around, all our investors said, we don't want to take 580 credit scores anymore. So we want 640 credit scores. And, once this pandemic gets, calms down, I'm sure they'll go back to lower credit scores. But for the most part, most mortgage companies want a 640 credit score or higher. Now, FHA, they could do credit scores down to 500. You might need a bigger down payment, and you probably won't get approved through the automated system unless you have a co-signer or something like that. But, FHA didn't change their credit scores because of the pandemic. But the investors that we sell the loans to, like Wells Fargo, Chase, PennyMac, they're the ones who are like, we don't want risky loans right now because of, people are losing their job, all this uncertainty. So you can't sell us a loan unless the borrower has at least a 640 credit score or higher. Some investors want 660 or some 680, but for the most part, 640 is the benchmark right now. And I'm sure that will change and get more lenient, as time goes by.
And you guys, when you run my credit, so let's say if I'm that person at a 620, so I'm 20 points shy of where I need to really be, I should really talk to a mortgage professional before I start doing anything to fix my credit, because you guys can run a simulation and tell me if you open a new credit card, you get so many points. You pay off this credit card, you get so many points. If you dispute it, you can run a simulation to tell me how exactly to get to that 640 I need to be at.
Yeah, we plug right into the credit bureaus and we say, what if this person paid down a credit card from 500 to a 0, or what if they got this collection deleted, or what if they opened a credit card? We plug right into Experian, TransUnion, Equifax, and it's pretty accurate. The only way it's not going to be accurate is, from the time we run it to the time we rescore it, things change with other credit cards. Like, for instance, if we tell you to pay down this credit card to $300 and your scores will go up 10 points, but if you max out another credit card in the meantime, then it's being counterproductive. But as long as nothing negatively changed, if I tell you you're going to get 10 points by paying down this credit card, it's not coming from me, it's coming from the credit bureau itself, and it's pretty close to being accurate.
Okay. That's important to know because, a lot of people try to fix it themselves and they do the wrong things and they don't hit the things that are going to have the biggest impact on their score. So I think it's important that they talk to someone as yourself.
For instance, a lot of times, people have old collections that haven't reported in years. They could be medical, they could be whatever cases. They could be like, the collection of three collection counts, one for 500, 600, and 700, but they haven't reported since 2013. We're not doing any more damage to your credit report. It hasn't reported for 7 years. But by you calling that creditor up and trying to make a deal because you're thinking you want to buy a house, that's doing the total opposite thing that you want to do. Because now you're like basically making a old delinquency now a new delinquency. Because now that creditor, let's just say it's Chase Bank, has a collection against you for $500, but they haven't reported since 2013. It might be on your credit report, but it's not doing any more damage. It's done. It's been 7 years. But by you calling Chase up and saying, well, I owe you $700, I want to satisfy you. Well, Chase is now basically making that a new delinquency, and that's going to bring down your credit score. So even though you think you're doing the right thing by paying this collection off, you're actually bringing your scores down.
Right.
Now, if that collection, the Chase is reporting every single month against you. So they reported in June 2020, July 2020, August 2020. Well, then that's something that you might want to take care of, because each month it reports against you, it's just putting another ding against your credit. So it just depends. So for somebody just to assume what to do could be a costly mistake. They could spend a lot of money paying off these collections that to hurt the scores in the beginning. Like, it might be okay for your credit scores in the next 6 months or a year, but in the beginning, when you initially pay that collection off, it could bring your scores down 15, 20 points. So this is exact opposite of what you want to do. You don't want to pay $600 and bring your scores down. So the best thing to do is to talk to somebody who has these tools to plug right into the credit bureaus, to not guess, and they can tell you for sure if paying this collection off is going to help or not do anything at all.
Right. So you can tell them exactly where to best place their money to have the most impact on their score to help them get qualified for the house they want. Right.
Exactly.
So, all right, I think we covered a lot here. I think it's a lot for a lot of people to digest, but just to recap a little bit, it is a short, painless communication with you or a loan officer like you to get that initial pre-qual. But I think the most important thing is the buyer needs to give you extremely accurate information over the phone, right? And not decide what they think you need to know, like to just lay it all out there, income, debt, everything, because you're going to see it ultimately anyway. And holding back that information could have a huge impact, 3 months down the line when they're supposed to be going to settlement on their house, and now we can't get it because we learned they didn't work the 40 hours, or there was a child support that we didn't know about, or whatever it may be at that point, right?
Just to add to that real fast is basically the loan officer has so many tools, but once it gets to underwriting, they have more tools. So they do more reports, and then they're going to see a lot more things than we initially see. So even though we miss something because you didn't tell us or it's not on your credit report, when we get the title work back or when the underwriters run a different type of report, we're going to see it, and then it's going to catch up to you before you buy that house. And then, like you said, you wasted everybody's time, you wasted your money, you're going to be very disappointed. So it's always better to tell us everything up front. Okay.
All right. So I appreciate you taking the time. I know you guys are swamped right now, just like we are, between refis and purchases. You're twice as we are. So I appreciate the time. Anybody that wants to get their pre-qualification, if you're in the tri-state area, or if you want to talk about your credit report or what you can do to get your score up to qualify, or you have some questions on a lot of the things we just talked about, in our show notes will be all of Jim's contact information and his license information and everything at GreenTree Mortgage. So you can email him or contact him directly. And of course, if you have any questions for us, you can contact us through the show as well. Jim, I want to thank you for taking the time. It was a pleasure. And stay busy. I got to get wrapped up here because I've got a 10 o'clock closing I've got to go to.
All right. Sounds good, man. Thanks.
Thanks a lot. Take care, and we'll see everybody at our next episode. And down the line, we'll be digging into a lot of those mortgage programs that Jim mentioned. We'll come back and do some more, and we'll talk about underwriting and processing and everything else, because there's a lot of lingos and abbreviations and everything that go into the mortgage business, and we'll get that cleared up for you as best we can. But there's only so much we can cover in a complicated issue in an hour. So, Jim, you have a great day. Tell everybody on the team I said hi. And I will talk to you shortly.